morning, dear students. Today I will be discussing about again accounting subject, which is principles or financial accounting, you can call it. Now, what are the different topics that today we will study? That is journal. You will understand journal, and then types of journal, and then we have compound journal. So, what is the difference between these two? And also, you will get to learn about these two different things. What happened? What is journal? Journal is nothing. It is the book of original entry which record the business transactions. So in the journal we are gonna doing nothing, but we need to keep the record. Even we define that accounting is the process of identification and records, classifying, summarizing, analyzing, interpreting and communicating of business transaction in term of money is called what? Accounting. Now that is the definition of accounting that we have. So the very first step of that definition is that identification and record, where we are identifying, where we are making the record, that is journal, nothing else. So in the journal we are keeping the primary record, the original record, the primary entry in the book of account, that is called what? Journal. Now we have two types of journal. That is, we have special journal, right? And also we have general journal. So in general journal, this format which we are using, that is general journal we are using, right? So we are making what? General journal. So what it have? General journal, it have 5 different columns and 6 elements. The first element is date. So we need to keep the date for that in the journal. And then in the second column we need to keep particular or description. In the third column we need to keep the post reference. The fourth column which we have, that is about debit. That is what part of identification, why it happening a debit balance or why it have a credit balance. And the fifth column is about credits, what is going out of the company, out of the organization, right? So we are keeping these things here in the credit. And here we have one more thing, that is narration. What is narration? Narration is the brief, in the bracket we are writing the brief summary of that transaction which has happened. Suppose this is the example is given. December 2 paid rent for shop 600. So what we have to do, we need to keep the record. So going to write on the format, journal, date, particular, post reference, and debit and credit column is there. So we are paying rent on December 2. So on the first column write down December 2. So here we making December 2, right? So that 2 is the date for the month of December. Like so here I am making that we are writing the December 2 for the month, right? So here writing December, right? So this is the month of December. So we are keeping the record in the month of December. So what's happening, or you can write in here in journal for the month of December, day 2. We paid rent for shop. So rent expenses to cash. So we discuss what is rent. Rent is nothing, it is expenses. So we discussed in the last chapter, that was classification of this transaction, that which categories belong to it, right? So we have 5: capital, asset, liabilities, revenue and expenses. So when increase, what happen when it have debit, and when it decrease, when it have a credit balance. So paying rent expenses, that is part of expenses. If we go back to that principles in the last session, So we said that when my expenses is increasing, in that case my expenses increase that have a credit debit balance, right? So here in the slide number 4 we discuss about the principles. This is the principle, right? So I am making copy of it to this slide after this principle, so to make it apply this. Now expenses increase, and increase in expenses have debit balance, so it have a debit column we writing. Cash is what? Asset. So asset is increasing or decreasing? So when you are paying expenses, your asset is increasing or decreasing? Obviously it decrease. So when it decrease, when expenses decrease, asset is decreasing. So where is asset? First one. Decrease in asset have credit balance, so it have a credit balance. So in the part 6 we said narration. So we are writing a summary of it. Paid rent and cash. That is what summary of this that we are writing here, that paid rent for in cash, that is summary of that, right? If you go to the second example, December 5, purchase equipment on account from Majid. So the name of Majid is coming in this transactions. So when the name of Majid is there in this transaction, so we are purchasing some equipment from him. So that is on credit or it is on credit base or cash base? No, credit base, because the name is coming and there is no term cash along with it. So equipment, we are not writing purchase equipment, we are using equipment because it is fixed asset, it is asset. To, or we can write on Majid account payable, right? So we are writing to Majid account payable that we have. So here that is what we need to write down, that equipment to Majid account payable. So purchase equipment is one thing and payment of that is the second thing. So equipment is asset. So asset increasing or decreasing? Obviously it increase. So increase in asset have debit balance. So coming back, equipment have a debit balance here. It have Majid is my liability account payable. So in its account payable, so liability is increasing or decreasing? Increasing. So when increase it have a credit balance. Increase in the liability have credit balance, right? Going question number 7, December 7, receive 525 from Said in payment of his account. Someone is, we sold something on credit, but now that person are coming and paying you money. So what happening in this case, that you are receiving money cash, right? On other hand, you are paying your liability of that staff which you have, that employee or that person that have, they will pay you. So that is also asset. So we are writing cash to account receivable Syed, or cash to Syed account receivable. Cash is my asset, increase. So when asset increase according to this principle have debit balance, and Syed's account receivable is again asset decrease, so they will not pay in the future, so that is decreasing in asset, so it have a credit balance. Next one is paid 380 for newspaper advertisement. So we are paying around of 318 rupees for the advertisement purpose. So what happening actually to this case, so we are paying money, so that is expenses, right, in the which is discussed in the December 2. So in this writing December 10 in column advertising expenses to cash, we discuss in the first, expenses increase have debit balance, where cash's asset decreasing have credit balance, right? Again December 20, paid 400 to Majid on account. So we are paying 400 to Majid, right? So paying money to him. So what happened, we are writing Majid account payable to cash, right? To cash, because paying Majid is your liability. So liability is increasing or decreasing? Well, when you're paying money, your liability is decrease, right? Obviously. So cash on other hand, cash is also decreasing. So liability decrease. So in decrease in liability here, it have a debit balance, right? Cash is asset, in decrease in asset have a credit balance, so it have a credit balance, right? And the next question which is there, December 25, received 960 for the customer service done. So what we will write down, we are receiving money, so cash to service received. So cash to service received we are writing here, and so when we are writing here cash to service received, that cash is what? My asset, right? And on other hand service is my income. So my cash, when I am providing more service, so my income is increasing or decreasing? Increasing. On other hand my money, cash is increasing or decreasing? Obviously decrease. So here increase in asset have debit balance, increase in income have a credit balance. So here increase in asset have debit balance and increase in income have credit balance, right? So this how to apply it. Next thing is about the next example, that is December 30 paid 200 for telephone bill. So what is telephone bill? So that is expenses, telephone bill expenses or telephone expenses to cash or cash. So telephone expenses is part of expenses, increase in expenses which we discussed in question number 3 and in December 2 and in December 10. That is also the similar transactions. So paying telephone bill expenses, that is the expenses increasing. On other hand cash is your asset, asset is decreasing. So in this case expenses increase that have a debit balance, and cash is your asset decrease that have a credit balance. On December 31st, paid 350 for supply consumed during the month. So we are paying for the supply, something is supplied to it and we need to consume that. So what happened? We are writing the simple supplied expenses or supplied consumed expenses to cash. So that is what, when supply expenses is part of expenses, so increase in expenses have a debit balance and decrease in asset. So when you are paying money cash to someone, so the asset is decreasing. So in this case when asset is decreasing, that have a credit balance, right? So that is the first part that we discussed. And second part we have about compound interest that we have in the journal. So what happened when two or more than two transactions are happening on the same date? So that kind of transaction is called what? Compound entry or compound journal entry which we have, whether it is on debit side, it is on or it is on credit side. Now see the very first example, it is clearly mentioned that start business with cash 10,000, machinery worth 5,000 and merchandise worth 5,000. Right? So if you see on the similar day, that is December 5, the same transactions on the same date happening. So three transactions, that is cash, machinery and merchandise. So these are three transactions happening on the same day, but we have to pass into one into it. So right, so the number of entries here we discussing before, that is saying single entry, and here we have multiple entries, that is more than 2 entry or more than 3 entry we have. So that is what is called compound. So how to keep the record of this? Here see we are writing cash to machinery, merchandise to capital. So cash is part of asset increasing, machinery is also part of asset that increase, and merchandise also that is part of asset here, so it increase. So that having a debit balance, where capital is part of capital and it also increase on the spot, that is having a credit balance, right? So the next one, like the second transaction, purchase merchandise from Farooq 3,000 and Sadiq 4,000. So we are purchasing something from Farooq and Sadiq for 3 and 4,000, right? So see, purchasing of merchandise is same, but we are purchasing on credit. So the credit amount is left on two persons, so we have to pay to him. I need to pay to Sadiq, I need to pay to Farooq. So we are writing simple purchase to account payable Farooq, account payable Sadiq. So for purchase, how much you are purchased? 7,000, where 3,000 is from Farooq and 4,000 is from Sadiq. And addition writing purchase merchandise on credit, simple. Next transaction, which is about sold merchandise for cash 1,500 and on account 3,000. So we are selling something for cash and credit bill, right? So we are writing cash, account receivable to sales. So cash is part of asset and account receivable is part of asset as well. So both of them are increasing. But on other hand, sales is my revenue, so my income or revenue is also increasing on the spot. So that is what is happening at credited balance. The next one, which is the third transaction, that sold merchandise is done. Fourth transaction, paid salary, cash salaries. So you're paying salaries, rent expenses, and office supplies. So payment, salary payment, rent expenses, office supply to cash or cash. Salary expenses part of expenses, rent expenses part of expenses, office supplies part of expenses. So all these three are part of expenses. So expenses increase have debit balance, where cash is part of asset. So asset is decreasing by amount of 700, so that have a credited balance, right? And the next one, the fifth one is receive cash from Shukur and Kaysel. So we are receiving cash from two sources. One is from Shukur and second one is from the cells. So here receiving cells, so cash we are receiving from both the source. So cash is asset that increase, it have a debit balance. Where account receivable we are receiving from Shukur, how much? 500, and we are selling something for 300. So the total amount I am receiving is 800. And then the last transactions, paid cash to Jamil and for insurance 500. So paying money to Jamil, so we borrowed, we need to pay the liability to Jamil and also for the insurance. So account payable, insurance premium to cash. So account payable, that is we are paying to Jamil 1000, and insurance premium, that is part of expenses. Also that we need to pay expenses increasing, it have a 500. Where cash is my asset, so asset is decreasing. So on other hand, so when I asset is decreasing, so it have a credit balance, right? This how to use this about journal compound interest and single entry. If you have any questions and queries, problems, so you can ask me through a channel or WhatsApp group. Thank you so much for your watching. Wish you all the best.